and welcome to the World Battery Metals and Mining News for the 2nd of September, 2024.
Tianqi Lithium swings to loss on battery metals price plunge. Tianqi Lithium Corp., one of China's key lithium producers, reported a hefty loss of 5.21 billion yuan, $734 million in the first half of the year, attributed to the collapse in lithium prices due to oversupply and sluggish EV demand. The price drop has led to a reevaluation of expansion plans and expenditure cuts across the industry. As a coping strategy, Tianqi shifted from quarterly to monthly pricing for spodumene concentrate from its Australian Talison project to better align with market fluctuations. Despite the turmoil, Tianqi remains optimistic about future market fundamentals and is keen on resource exploration alongside top miners. It also obtained board approval for commodity hedging, but has yet to utilize it. Concurrently, Tianqi faces geopolitical challenges, notably tensions with SQM over a proposed joint venture with Codelco, which necessitated legal action in Chile. The company pledges to protect its shareholder rights and engage actively with all stakeholders. While the lithium market's volatility and regulatory hurdles persist, the industry's resilience will be tested by these ongoing pressures. Goldman Sachs takes substantial stake in Latin Resources. Latin Resources, ASX-LRS, a lithium explorer in South America, has seen investment heavyweight Goldman Sachs snap up a 5.2% stake following a takeover bid from lithium giant Pilbara Minerals. Not to be outdone, UBS has increased its stake to 7.49%. The proposed deal values Latin Resources at a juicy 57% premium, sparking a 79% surge in their shares. Latin Resources' managing director, Chris Gale, practically threw in the towel, admitting the harsh realities of raising capital in today's market and seeing the merger as a protective measure. Meanwhile, Pilbara Minerals offers a lifeline, proposing a 0.07 share exchange under a binding scheme, shifting the risk calculator and promising a smoother pathway for the embattled junior. Notably, all Latin Resources directors are on board, seemingly ready to ride Pilbara Minerals' coattails out of the lithium storm. Teck announces new business structure, leadership team, post-coal exit. Teck Resources is shaking things up, transitioning to a pure-play energy transition metals player. They've unveiled a new structure featuring North American and Latin American units. North America will oversee their copper and zinc operations in BC and Alaska, alongside promising growth projects in BC and Minnesota. Meanwhile, Latin America will focus on their copper ventures in Chile, Peru, and Mexico. This rejig follows Teck's lucrative sale of its BC-based steelmaking coal division to Glencore, snagging nearly $7 billion for a 77% stake. With a streamlined executive team and a robust projects group, Teck aims to balance copper growth with shareholder value. Teck CEO Jonathan Price emphasizes this move is all about operating efficiently and responsibly while seizing growth opportunities. Despite the corporate shuffle, some familiar faces remain, including Fraser Phillips, who will stay on until his retirement in 2025. All in all, it sounds like Teck is getting its ducks in a row to ride the upcoming metals boom. Smart move, if you ask me. Harmony Gold says profit soared 78% on higher output and prices. Harmony Gold Mining Co. has reported a substantial 78% increase in profit for the past fiscal year, fueled by record bullion prices and a 6% rise in production to 1.56 million ounces from its operations in South Africa and Papua New Guinea. The Johannesburg-based company expects to report earnings of up to 13.88 Rand per share, with financials to be disclosed on September 5th. This impressive performance is bolstered by their Mamponeng mine, the world's deepest, acquired from AngloGold Ashanti Limited, which saw remarkable operational success. Headline earnings surged by 131.6%, and the company's stock has appreciated over 40% this year. Quite the feat in today's roller coaster market. Albanese slams Dutton's do-nothing approach. Prime Minister Anthony Albanese unleashed a fusillade at opposition leader Peter Dutton's plan for nuclear energy, decrying the delay and expense while on a tour of Western Australia. Albanese's visit to the Collie Big Battery construction site threw shade at Dutton's grand nuclear visions, arguing they wouldn't meet West Australia's immediate needs. Meanwhile, Albanese hinted at potential tweaks to his environmental watchdog proposal to secure parliamentary support, but noted parts might be shelved until after the election. On a brighter note, Albanese also inspected International Graphite's development facilities in Collie, showcasing Australia's first downstream graphite pilot plant. This facility, funded partly by government grants and set to bolster Australia's battery minerals industry, exemplifies effective, forward-thinking resource management. The Collie site is set to enhance International Graphite's credentials with its expanding product range from battery materials to aerospace, all without the drama and delays of nuclear power politics. Disappointing Chinese manufacturing data drives ASX down. Today's market was not kind to gold miners as the S&P ASX 200 faltered by 27.90 points to land at 8,064 points. Materials and industrials both slid, taking hits of 0.774% and 0.55% respectively, while the energy sector managed to climb by 0.33%. Among the biggest losers, Red 5 plummeted by 8.8%, Perseus Mining fell 6.8%, and Genesis Minerals dropped 5.5%. The market's downturn was largely influenced by poor economic data from China, where the manufacturing sector contracted for the fourth consecutive month, with the Purchasing Managers' Index at 49.4 points. Anything below 50 signals contraction. Meanwhile, Chinese steel exports are projected to soar, potentially flooding the market and escalating global trade tensions. With a slower-than-expected economic growth of 4.7% in the second quarter, Chinese producers are offloading their surplus steel, primarily to Southeast Asia and Europe. Despite the recent slide, the S&P ASX 200 has managed a 0.50% gain over the past 5 days, still hovering 1.4% below its annual peak. As usual, amidst the gloom, there's always a gem like Downer EDI, which spiked 4.3%, keeping the index interesting. Strategic European investors the go-to as retail market dries up. Junior mining companies worldwide are finding equity markets increasingly inaccessible, with the ASX Group report showing an 8% drop in secondary capital raised for the 2024 financial year to date, alongside a rise in company delistings. The demand for lithium, once a hot commodity, has dampened due to price deflation, evidenced by dwindling investor activity. However, strategic investors remain interested, particularly in materials crucial for the battery industry, like lithium, nickel, cobalt, and copper, exemplified by deals such as Stellantis' substantial investment in Conoco's projects. Despite the challenges in equity markets, various funding avenues are available, including the European Union's Critical Raw Materials Act, CRMA, which supports projects essential for the EU's green transition even if located outside the EU. Companies are also tapping into funds from entities like the European Bank for Reconstruction and Development, EBRD, KfW, and the European Investment Bank, EIB, highlighting the importance of securing strategic offtake agreements to mitigate investment risks. Although opportunities abound, junior miners must navigate an increasingly complex funding landscape to capitalize on these initiatives.